Good afternoon, folks. Welcome to the National Business Inclusion Consortium and Federal Reserve Bank of Boston Main Street Lending Program webinar. My name is Sabrina Kent, and I am a Senior Vice President at the National LGBT Chamber of Commerce. We are so glad to have you here with us today for an exciting program. A few notes of housekeeping before we get started today. For questions, please use the chat and Q&A functions on Zoom. We've allotted approximately 20 minutes for Q&A at the end of today's program, so we will get to as many questions as possible. Today's program is being recorded, so if there are any details you missed that you'll need to revisit, or you feel it's valuable to pass this information along to other business owners within your network, we will be sharing this recording post-program. And again, if you have any questions related to the status of your Main Street Lending Program application that has already been submitted, it is best to contact your local Federal Reserve Bank directly. So with that, it is my pleasure to turn it over to our co-founder and president at the National LGBT Chamber of Commerce, Justin Nelson.
Hey, Sabrina, thank you so much. And thanks to our partners at the Federal Reserve Bank, the Federal Reserve Bank of Boston. I am Justin Nelson, the co-founder and president at NGLCC. My pronouns are he, him, his, and I want to welcome you all to this National Business Inclusion Consortium collaboration. Some of you, Ramiro, Ron, Susan, long time no see. We were on a program earlier today with the Chamber Leadership Alliance, so good to see your faces again. I also want to welcome all of our other NBIC consortium partners. Thanks for your work in helping all of us make it a more equitable and diverse place for our collective constituents. It is no secret that a number of our businesses, whether they're business owners of color, LGBT, veteran, women, or all of the above, are facing some very long odds and difficult times during COVID. So we are pleased to be able to bring this program to you today as one more resource to help our businesses survive and thrive in these difficult times. I want to give a special thank you to Leroy Cavazos and our friends at the U.S. Hispanic Chamber for helping lead this program today. And I hope that you all enjoy the information that's shared, ask questions, and find this a useful resource. So without saying much more, it is now my pleasure to turn it over to my colleague, Mr. Philip DeVlieger from Disability In, the Vice President of Supplier Diversity. Philip?
Justin, thank you. It's such an honor to be part of the NBIC and all the great work that our colleagues are doing. Again, I'm Philip DeVlieger, Vice President of Supplier Diversity at Disability In. And at Disability In, we empower business to achieve disability inclusion and equality. As we celebrate the 30th anniversary of the Americans with Disabilities Act this year, and on behalf of all of our certified disability-owned businesses and corporate partners, I would like to invite everyone to join us in being in and building a truly inclusive global economy. And with that, it's now my pleasure to welcome Adrian.
Thank you so much, and I'm so glad to be a part of this program today. I appreciate the opportunity to join my colleagues with the National Business Inclusion Consortium. Again, I'm Adrian Trimble, President and CEO of the National Minority Supplier Development Council, and our mission is to connect our corporate partners with our more than 12,000 certified minority businesses for their supply chain needs. And as we all know, these challenging times are unprecedented for us right now. All of our small businesses are significantly challenged to stay sustainable and operational, and programs like these will help them be able to understand what options and resources are available. So glad that we're able to bring this type of programming to you. Thank you all for joining today, and now I will introduce my partner at Novobo, Matt Pavelek, who will now introduce himself and his organization. Matt, to you.
Thank you, Adrian. And thank you very much to Sabrina for organizing this. And thank you, Justin, and everybody at the NBIC, all of our partner organizations. We're very grateful to be included, to make sure that veterans are part of all of our efforts to make sure that everything we're doing is inclusive of the business community and helping them succeed during this difficult time. I'm Matthew Pavlik. I'm the president and CEO of the National Veteran-Owned Business Association. And the veterans that are part of our community are unique in that everybody that's served for the last 45 years has done so voluntarily, and they are members of all of the other communities. They are diverse in every way imaginable. They've just chosen to serve our nation. So thank you again for including veterans in all of these efforts. And I would like to take the opportunity to introduce Ron Busby, who is the president of the U.S. Black Chamber of Commerce.
Thank you, Matt, for the introduction, and thank you to the consortium, as well as the other members that are joining this call this afternoon. Again, my name is Ron Busby, and I'm the president and CEO of the U.S. Black Chambers, Inc., headquartered here in Washington, D.C. We represent 145 chambers in 42 states with a membership base of over 332,000 Black-owned businesses. This is an exciting time for us as this month represents Black Business Month. And so with that in mind, we are honored to be discussing this conversation as it relates to how we can continue to move our businesses forward through the relationship of the Federal Reserve Bank of Boston, along with the National Business Inclusion Consortium. We represent the 5 pillars, which are advocacy, access to capital, which we're going to discuss today, contracting opportunities, entrepreneurial training, and chamber development. We're excited to be here to talk about the future of Black-owned businesses. And with that, I'd like to transfer the conversation to my good friend, the president and CEO of the U.S. Hispanic Chamber, Ramiro Cavazos.
Thank you. Thank you so much, Ron. It's a pleasure for me to be here with all of you. We are proud to be members of the National Business Inclusion Consortium and prouder of the partnership we have with you, Ron, and everyone on this call that stands for what's right in our economy, and much work remains. Our solidarity is important, and as you all know, ideas alone are not actions, so we're very grateful today to be partnering with the NBIC, leading the conversation with the Federal Reserve Bank of Boston to talk about opportunities to provide more capital. As a chamber CEO, I am very grateful to work for 5 million Hispanic-owned businesses. Our network has 250 Hispanic chambers around the country and Puerto Rico, and our work will continue to live on until we have true equality for everyone on this call. As we move forward, I'm also proud to welcome to each of you my great colleague, Susan Allen. She's the National President and CEO of the United States Pan-Asian American Chamber of Commerce. Susan, thank you for your leadership. And as I turn this over to you, thank you to Sabrina and her great work and leadership in shepherding all of us along with Leroy on our team. Thank you, Susan, for your leadership.
Well, thank you, Ramiro, and I want to join you in thanking all those who've helped to make this program possible. That's right, I'm Susan Allen, National President and CEO of the U.S. Pan-Asian American Chamber of Commerce Education Foundation. And this year we celebrate 35 years of service to the Pan-Asian American business around the country, about 3 million of them, representing about 1 trillion in gross income in the country. Not too small an amount for about 20 million people in the country. And this is our partnership again with the NBIC. Thanks again for Justin and Ramiro and also Ron, who have been with this NBIC at the very beginning, 10 years ago now. And I'm glad to be part of this program to help to co-host the Federal Reserve Main Street Lending Program. You see, COVID-19's economic impact continues, and we need to produce more financial resources to the small and minority business community. And this Main Street Lending Program is going to inject additional financial assistance to the small business community to help them get back on their feet, to ride the storm and come out of this in good shape. But at times like this, leaders like you all in the audience and us, business community leaders, got to understand that as we pivot to this new business environment, we got to be more creative and more conscientious about why we are where we are today, why we have embarked on this mission. And that is to help our businesses grow, nurture, and expand in the marketplace, both domestically and in the foreign markets. What do we have to do? We have to pivot. We have to be able to create different dimensions and meet the demands of our customers who are in need of financial help and also counseling and assistance. So the Federal Reserve Bank's Main Street Lending Program is just a start. We all have to do our part to help them, and this is a great start. The rest is up to us. Thank you very much for joining, and have a very great program.
Thank you, and
Now,
welcome.
I would like to pass this torch to Michael Dobowski of WeConnect International.
Thank you, Susan. Hello, everyone, and welcome. And thank you for the opportunity to be here today. I'm Michael Tobolski, Vice President of Member Development at WeConnect International. Our organization, WeConnect International, is a member of the National Business Inclusion Consortium and is a global partner of WeBank. We work outside of the U.S. in over 120 countries to identify, educate, register, and certify women-owned businesses that are at least 51% owned, managed, and controlled by one or more women, and connect them with multinational buying organizations. We also support US-based women-owned businesses with expanding internationally. We're honored to support the NBIC and Federal Reserve Bank Main Street Lending Program. And now I would like to introduce you to Candice Waterman, President and CEO of Women Impacting Public Policy. Thank you. And Candice?
Thank you, and good afternoon, everyone. I know my picture on the screen and the picture that you're seeing looks like two different people, but it is me. It's what happens when you are at home for more than 20 weeks. I would like to say that we are a proud participant and member of the consortium, and I am honored to work alongside these great colleagues of mine whom you have had an opportunity to meet, and one more after me that will have an opportunity to speak. WIP, Women Impacting Public Policy, is the nation's leading and largest nonpartisan organization representing women on the Hill in business. We are proud to represent our over 12.3 million women-owned businesses in the country. WIP speaks 3 languages, as I say, that's advocacy, community connections, and education. And we are very proud to be your voice on the Hill as we try to ensure that there is policy in place that is going to help you succeed as businesses. I want to thank the Federal Reserve Bank, the Federal Reserve Bank of Boston in particular, for this great resource. We know that access to capital is not just a barrier to entry, but a barrier to growth for our businesses. And in this particular unprecedented space that we are in our country, we need this more than ever. We cannot have too many resources. We cannot be over communicative. And so I am very, very honored to be part of the consortium and a co-host for today's program. So enjoy, and thank you all as participants for taking your business in your own hands today. With that, I'd love to turn it over to Jill Sasso, my friend, Vice President of HR, Governance, and Programs for WeBank, Women's Business Enterprise National Council.
Well, thank you so much, Candice. And I just echo all of the comments of the NBIC members today. We are so proud to partner with all of these wonderful organizations as part of the NBIC. And we're very proud to bring you this program today in conjunction with the Federal Reserve Bank and the Federal Reserve Bank of Boston. So want to just tell you that I'll just echo the comments that Candice just made. We are close partners there, and WIP is our national partner organization. So we share that mission and that passion for getting all of our small and diverse businesses the funding that they need during these trying times. And so programs like this are exactly what they need in their hands right now in order to continue to have cash flow and survive and make it to the next phase of business. So Again, I do represent WeBank, the Women's Business Enterprise National Council. We have somewhere between 15 and 16,000 certified businesses. We're women-owned businesses. We are the largest certifier of women businesses in the U.S., and we also connect them to opportunities, resources, and engagement. And so we're very proud to bring them this opportunity that we're about to hear about today. So welcome, enjoy the program, and I look forward to hearing what's coming next.
Good afternoon, everyone. On behalf of the National Business Inclusion Consortium and its partners, we welcome the Federal Reserve Bank of Boston and our partners at the Federal Reserve for today's critical presentation on the Main Street Lending Program. Right now, it is my honor and privilege to present our speakers for today. James Nolan is the Executive Vice President of the Federal Reserve Bank of Boston. Molly Mahar is the Associate Director, Division of Supervision and Regulation of the Board of Governors of the Federal Reserve Bank System. They will be presenting today's presentation on the Main Street Lending Program. Facilitating questions after this presentation is Christine Doherty, Vice President and Associate General Counsel of the Federal Reserve Bank of Boston. It is important to note that throughout this presentation, Molly Mahar is a representative of the Federal Reserve Bank Board of Governors and has been integral in setting up the Main Street Lending Program. Jim Nolan and Kristen Doherty are integral members of the Boston Federal Reserve Bank team who are operationalizing the Main Street Lending Program. It is critical that we ask the questions necessary to access this facility on behalf of the Federal Reserve Bank, as together we unite with our partners at the Fed to move the American economy forward. At this time, it is my honor and privilege to turn it over to James Nolan and Molly Mahar.
Thank you very much, Leroy. And thank you to everyone who joined us today to learn more about the Main Street Lending Program. Today's program is designed to help potential borrowers better understand this CARES Act lending program and help borrowers decide whether the program is appropriate for them given their current circumstances. Before I get into the meat of the presentation, I'd like to offer a clarification. On the second slide that Sabrina shared, there was a note that indicated if a borrower has a question about a pending application, they should call their local reserve bank. As we will discuss as we move through the presentation, the Main Street Lending Program is very unique. It is not the Federal Reserve banks that are actually providing the loans to borrowers. We work through a network of lenders who have opted to participate in the program. So to the extent a borrower had a question about a Main Street loan, we would suggest that they work with the lender to whom they submitted the application. With that, I will jump into the presentation. Next slide, Sabrina. This slide lays out the agenda for today's session. We would like to provide an overview of the Main Street program, describing key program terms and conditions, and outlining how the mechanics of the program work. We'll also spend some time discussing the conditions that borrowers are agreeing to when they participate in the program, and the borrower documentation that must be executed to be eligible to receive Main Street loans. We'll explain how to get started on submitting an application to the program, and as mentioned, we will finish by answering questions as time allows. Next slide, Sabrina. So the Main Street Lending Program is designed to provide credit to a wide variety of small and medium-sized for-profit and not-for-profit businesses that were doing fine prior to the onset of COVID-19. And these firms were adversely impacted by the consequences of the pandemic. The program is focused on helping these businesses maintain operations and payroll. Main Street adds credit capacity to the financial system with the goal of providing a bridge for small and medium-sized organizations to better economic conditions. It accomplishes this by assuming most of the risk associated with loans that are made by lenders participating in the program. This enables lenders to make loans that they might not have otherwise made, and hopefully creates additional lending capacity by removing 95% of the loans from the lender's balance sheets. The overall objective is to increase the amount of credit available to businesses impacted by the effects of the pandemic. Next slide. So this slide includes a schematic that lays out how the program works. Let's start on the right side of the slide, where you'll see the program's special purpose vehicle, which we have established using up to $75 billion in equity from the United States Treasury and loans from the Federal Reserve Bank of Boston of up to $600 billion. As the slide indicates, there are now 5 separate loan facilities within the program, allowing lenders and for-profit and not-for-profit borrowers the ability to tailor credit solutions to individual circumstances. Now let's move to the other side of the slide, where you see the first steps in the process is where a borrower applies for a Main Street loan with a lender eligible to participate in the program. The lender evaluates the application using not only the Main Street program eligibility criteria, but also their own underwriting standards. If approved, the lender funds the loan and sells a 95% interest in that loan to the Main Street special purpose vehicle. The lender then retains the 5% interest in the loan and continues to service the loan with the borrower. Next slide, Sabrina. So the 3 loan types targeted at for-profit businesses and the 2 focused on nonprofit businesses have been designed to accommodate a significant amount of tailoring to ensure that a wide variety of small and medium-sized borrower needs can be met. Key features of the program include the availability of a wide range of potential loan sizes, attractive repayment terms, notably the deferral of interest and principal payments, as well as the availability of both secured and unsecured loan structures. Nonprofit loan terms are similar to those for the for-profit businesses, but have been tailored to reflect important differences between these 2 types of firms. It is important to note that Main Street loans, unlike the loans available from the SBA's PPP program, are not grants and cannot be forgiven. Molly is going to pick up the discussion from here and review in more detail the features of the loan facilities within the Main Street program, as well as terms and conditions. Molly?
Thanks, Jim. If we can turn to the next slide. Great. So in the next few slides, I am going to be walking through the basic terms for Main Street loans for-profit businesses as well as nonprofit businesses, and then talking a bit about the eligibility criteria for each of the facilities. And as Jim indicated, I'll be walking through kind of how to get started and the types of information and other documentation that will be needed to participate in the program. So if you see here on this slide 20, these are the basic terms for eligible loans in the for-profit business side of the Main Street lending program. There are 3 loan facilities for for-profit businesses. The new loan facility and priority loan facilities offer new loans. So they are available to existing customers of an eligible lender participating in the program, as well as new borrowers. There's a 3rd facility, the expanded loan facility, which is a facility that expands or upsizes an existing loan. So that is available for lenders and borrowers with existing relationships. If you look across the top here on the basic terms of a Main Street loan, it's a 5-year term loan. They'll have an adjustable rate of LIBOR 1 month or 3 months, plus 300 basis points. Again, that's the same across all of the loan facilities. In terms of principal payments, the principal payments on a Main Street loan are deferred for the first 2 years. And then the principal amortization schedule is at the end of years 3, 4, and 5 at a rate of 15%, 15%, and 70%. So the amortization schedule is really geared toward the current COVID-19 pandemic period, in recognition that it may take businesses time to recover fully from the current conditions. I would note, however, as you look further down on this table, that prepayment is allowed without penalty in this program. So if a borrower chose to prepay the Main Street loan at an accelerated rate, that is possible. Interest payments are also deferred in a Main Street loan in recognition of the uncertainty in the current economic environment. Moving to the next few rows, you can see there are important differences in the for-profit business side of Main Street across these three facilities. And the first difference is the range of loan sizes available in each of the facilities. The first new loan facility is between $250,000 and $35 million. You can see the priority loan facility also starts at $250,000 and goes to $50 million. And the expanded loan facility is from $10 million to $300 million. Again, that expanded loan facility is really geared towards the larger part of the small and medium-sized enterprise targeted borrower population for these loans that tend to have more complicated existing debt structures, and for which expanding an existing loan would be a good option. You can see here in terms of maximum loan size, the maximum loan size is really the lesser of the top end of the loan size range, and a leverage requirement, which differs across these facilities. So for the new loan facility, the borrower's existing outstanding and undrawn available debt cannot, with the Main Street loan, cannot exceed 4 times their adjusted 2019 EBITDA. And that's earnings before interest, taxes, depreciation, and amortization, which many of you will be familiar with. The other two facilities have a leverage requirement up to 6 times the adjusted 2019 EBITDA, but there's not reflected on this table another important differentiating factor that allows for these different leverage levels. And that is in the new loan facility. While new loans cannot be contractually subordinated in terms of priority and bankruptcy, they do not have a requirement with regard to security on the existing debt on a borrower's balance sheet. So you can have an unsecured new loan in the Main Street program, for example, even if you have existing secured loans. At the same time, the priority and expanded loan facilities do have a requirement that those loans be senior to or equivalent in security to existing loans. There are more details about all of these elements in the term sheets and frequently asked questions that are posted on the Federal Reserve Bank of Boston's website. Those term sheets have important details, and I would encourage you to look at those. As Jim indicated, the participation rate for all of the 3 for-profit loan facilities is 95% for the Main Street SPV and 5% retained by the lender who's originating the loan. Again, just to reiterate that prepayment is allowed without penalty in a Main Street loan. And again, would refer you for origination and transaction fees to the program documentation. They differ slightly for the new loan and priority loan facilities versus the expanded loan facilities. Sabrina, if we could move to the next slide. So the next slide is a similar table that lays out the terms for the 2 facilities that are available for nonprofit organizations. I would note that while the Main Street for-profit 3 facilities are operational and the SPV is purchasing loan participations for those 3 facilities, the nonprofit organization facilities are not yet operational. We have published finalized term sheets, and we have also recently posted the legal documentation that is required for loan participation in this program, and have published a series of FAQs as we work towards fully operationalizing these 2 facilities. You'll see here there are 2 facilities available for nonprofit organizations, a new loan facility and expanded loan facility. They have the same general loan term, interest rate, principal repayment schedule, and interest payment schedule as the for-profit facility. Also, the loan size ranges are similar to the for-profit side. But one important difference, which is listed in red to bring your attention to, is that the maximum loan size does not use the same leverage measure that is used in the for-profit facility. Instead, for the nonprofit facilities, it's the maximum loan size for any individual borrower would be the lesser of 35 million, for example, for the new loan facility, or the borrower's average 2019 quarterly revenue. That's the same for the expanded loan facility. Again, the lesser of the top end of the range, which is 300 million, or the borrower's average 2019 quarterly revenue. This just reflects differences in the operations of nonprofit and for-profit businesses and reflects their potential need during these times. The participation rate for the Main Street SPV is the same for these facilities at 95%, with the eligible lender retaining 5% of the loan, and the loan fees and prepayment without penalty is also the same across these facilities. Sabrina, if we can move to the next slide. Thank you. The next slide lists out the eligible lenders to participate in the Main Street program. As Jim indicated, the Main Street program starts with eligible borrowers seeking a loan from an eligible lender. So it's important to know the range of potential lenders for the Main Street program. They are, you can see on the slide, U.S. federally insured depository institutions, which would include banks, savings associations, and credit unions. Any U.S. bank holding company or U.S. savings loan holding company would be an eligible borrower. In terms of foreign banks, their U.S. branches and agencies and U.S. intermediate holding companies are eligible, as well as any U.S. Subsidiary of the above mentioned institutions. I will pause here and note that we have received questions along the way as we've done a lot of outreach and received feedback on the program about potentially expanding the list of eligible lenders. As we've moved to operationalize the program, we have focused on those lenders, since their underwriting is a very important part of this, that are federally regulated entities. However, we are looking at the issue of whether we can expand this list, and that is something that is ongoing as we evaluate the efficacy of the program more generally. Okay, we can move to the next slide. So the next few slides talk about eligible borrowers. As you can see here, we use sort of some similarities, but there are some important differences across the for-profit and nonprofit facilities in the Main Street program. Starting on the left-hand side with small and medium-sized for-profit businesses, the businesses must have been established prior to March 13th, 2020. They may not be an ineligible business, and there we are using the definition of ineligible business that's been used and clarified by the SBA regulations for the purposes of the PPP program. We've listed here references in our term sheets as well as our FAQs E1 and E13 for more details on what may be an ineligible business for the purposes of the program. Moving down though, small and medium-sized businesses that have fewer than 15,000 employees or 5 billion or less in 2019 annual revenue would be eligible for the program. There are additional financial criteria that we list here as described in the term sheets for the purposes of the for-profit business side. That's generally the leverage level, which also governs the loan size of the different facilities. So switching to the right-hand side of the table, here you see small and medium-sized, still on the same slide, small and medium-sized nonprofit organizations are, there are two general categories: U.S. tax-exempt nonprofit or veterans organizations, as described in Section 501c3 or C19, respectively, of the Internal Revenue Code. And it's important additional criteria here for nonprofit organizations is that they must have been in continuous operations since January 1, 2015. You will see we have a few additional operational criteria, operating capacity criteria for the nonprofit organizations. Because this is a loan instrument and a loan tool, we are cognizant that that's not often the way in which nonprofit organizations fund themselves. So we have some operating criteria in here to ensure that the nonprofit organization would be in a good position to manage a 5-year term loan. You'll see we have the ineligible business definition that mirrors the for-profit side, the same 15,000 or fewer employees or up to $5 billion in 2019 annual revenue. But again, on the operating criteria, we also have a criteria for eligible nonprofit organizations that they must have at least 10 employees. I will say this was originally set higher in terms of the minimum employee size, but we did get feedback in our consultations on the nonprofit part of the Main Street program that many nonprofit organizations rely on volunteers and may have operating capacity well beyond with even a few employees. So we did lower that number. There's additional financial criteria described in the term sheets for nonprofit organizations. I will mention them here, but really would encourage you to look at the term sheets for the specific definitions. There are 3 financial criteria that are very familiar to those of you in the nonprofit sector or who have been engaged in nonprofit lending. They are the operating margin of the organization, which must be greater than 2%. Days of cash on hand, which is basically liquid assets over average daily expenses of 60 days or more, as well as a debt repayment capacity, which is unrestricted cash and investments over debt. So those categories, again, are listed in the term sheets with regard to nonprofit organizations, eligibility to the program. Moving to the next slide, just touch briefly here, and this is laid out in FAQs E3 and E5. We have quite a large FAQ document with regard to the Main Street program as it has grown. I would encourage you to go there, but we like to put the references here to make it easy for you to find the relevant questions. This is about affiliation criteria. So for businesses and nonprofits, in order to understand whether you have 15,000 or fewer employees or meet the 2019 annual revenue of $5 billion or less, this must be met together with affiliates. So affiliates need to be aggregated together. There's some additional information here about how, where to look in terms of employees and revenues and how to calculate those figures. Businesses, for example, should average for each pay period over the 12 months prior to the origination or the upsizing of an expanded loan, the aggregate total number of full-time employees. Businesses also may use U.S. GAAP audited financial statements or annual receipts as reported to the IRS. If you can go to the next slide, great. These are borrower conditions and certifications. So just a note in terms of how the Main Street program interacts with other Federal Reserve facilities and potentially other government programs. So we did design the Main Street program so that it meets the population that's not been served by other Federal Reserve facilities that have been set up in the pandemic era. So first off, borrowers may participate in only one of the Main Street facilities. So if you participate in the new loan facility, for example, and you haven't met the maximum loan size for your business, you could seek a second Main Street loan, or an affiliate could seek a Main Street loan, but all of that activity would need to happen in a single facility. For example, the new loan facility or the priority loan facility. Borrowers may not participate in both the primary market corporate credit facility, or for nonprofits, the municipal liquidity facility and Main Street. Borrowers can only participate in one of those programs. But I will say that borrowers that have received loans under the CARES Act PPP program or under the Economic Injury Disaster Loan Advance Program may participate in Main Street. So while there is a restriction on the other Federal Reserve facilities and participating in only one, it is possible to participate in the PPP program, for example, on the Main Street program. Moving to the next slide. If we can advance to the next slide. Oh, there, you advanced, sorry. So borrower conditions continued. lenders and borrowers will be required to sign borrower and lender certifications and covenants when they engage in a Main Street loan. In general, from the borrower perspective, among other things, there's a certification on early repayment of debt. So if a borrower takes a Main Street loan, they may certainly continue to pay off their existing debt based on the schedule that was in place before the Main Street loan took place. So this is not a prohibition on paying regular interest and principal payments as they come due, but it is a prohibition on accelerating or early repayment of other debt before the Main Street loan is paid off. Borrowers cannot ask for lines of credit to be reduced. They must be able to meet their financial obligations for the next 90 days. And there are CARES Act restrictions because the program is part of a CARES Act funding, distributions and equity repurchases, as well as conflict of interest. Those are all described in our term sheets as well as in our FAQs. And again, I would refer you there to learn more information about those aspects of the program. So moving to the next slide. So getting started, again, as Jim mentioned, and I indicated earlier in my remarks, interested businesses should start the process by first attending programs like these and reviewing program requirements that are laid out in our term sheets, but also contacting their lender to discuss applying for a Main Street loans. Borrowers must complete both the program documentation, for example, the certifications that I just walked through, as well as the lender's loan documentation. The lender's loan documentation will be an additional part of the program, and that's what the basic loan contract would be written under. Lenders will apply their own underwriting standards in evaluating the financial condition and creditworthiness of borrowers. That's an important additional aspect of this program. But I think all lenders and the spirit of the Main Street program is to make sure that we're providing assistance and credit support to those businesses who, again, were in a sound financial condition before the crisis, and to bridge this period of uncertainty. Ultimately, lenders would determine whether borrowers were approved for a Main Street loan, and then the lender would bring approved loans to the Main Street SPV for participation. Flipping to the next slide. So here I would refer you to the bostonfed.org website, where we do have an interactive map set up for borrowers to view, again, a state-by-state listing of those lenders who are currently accepting applications for new customers. This is really easy to use, and you can go in, click, and lenders, again, who are accepting applications for new borrowers are listed there if you're interested in engaging in the Main Street program with a new lender. Flipping to the next slide, required borrower information here. This is just to, again, provide as much information as we can in a format such as this one about what can be expected during at origination and during the life of a Main Street loan. So lenders are required to collect certain information from borrowers, both at the time of application and periodically through the life of the loan. And these include general identifying information, such as a name or tax ID, business establishment date, also some financial data, which will be familiar to your businesses, assets, liabilities, revenues, expenses, additional items are listed in our FAQ document, and collateral information, if applicable, if your Main Street loan is a secured loan. Again, Appendix C of our FAQ document does have a complete listing of this required data, the periodicity, so you should be able to see and understand all of the program requirements from that document. I think the next slide, I'm turning it back to Jim to talk about the additional resources that are available. Jim?
Thanks, Molly. So we've covered a lot of ground in a very short period of time, and we know that's a lot to digest. What we've provided on this slide is some reference material and ways to get more information about the Main Street Lending Program. We've mentioned several times now that the Federal Reserve Bank of Boston has a dedicated website for the Main Street Lending Program. It's bostonfed.org/MSLP. That site includes all program materials, forms, documentation, and as Molly mentioned, a very comprehensive set of frequently asked questions dealing with the Main Street program. We would encourage you, if you're interested, to visit the website. The program does evolve, and if you would like to be alerted to updates in the program, we do have an email subscription registry, which you can either directly access using this link, or it's also accessible on our website. And then finally, if you have more specific questions in terms of how the program actually works, we have a dedicated, fully staffed mailbox, which we answer quite promptly, and the address is there on the screen. So I think we're turning it back to Sabrina to coordinate questions.
Thank you so much. Thanks for sharing your time and expertise with us, Molly and Jim. We're so glad to have you here today. So I'd like to also welcome Christine Doherty, who my colleague Leroy welcomed at the onset of today's program. Sorry, looks like we're having some slide trouble here. For today's Q&A portion of the program. To start, Jim, Molly, and Christine, one question that we received prior to the program is, once a loan is completed, if the borrower wished to bring a new business partner on board, can that person be added to the loan?
Sorry, I can start off. I think you can see me now. It keeps asking me for video permission. Apologies for the delay. So I think that the question is about having multiple borrowers on a loan. Is that right, Sabrina?
Right. So what they're saying is if they brought on a new business partner, would they be able to add that new business partner to the existing loan?
So, it's a great question. I guess I'll start by saying, in terms of guarantors, for example, on a loan, the Main Street facility can accommodate multiple guarantors if that's the structure that was working. We also have recently posted an adjustment to the legal documentation around participations to allow for multiple borrowers on a single loan, but that is going to take us a little bit more time to make operational. So it's not fully operational now, but we've received this question in the past, and we are moving forward so that will become available. And again, we have adjusted our legal documents for that, so would encourage the questioner to stay tuned on that one. In our FAQ, we note that it's going to be in the coming weeks or so when that capability will be there.
Thank you, Molly. So similarly to that end, if one of the business partners leaves the company and they retire or leave for any other reason, can they be removed from the loan, or is that something folks should also refer to the FAQ for?
So I guess we'd have to get back to you on specific details on that. I don't think we have an FAQ that contemplates one of the parties to the loan being removed. I think when that a lot of that would have to do with the specific lender borrower specifics around the loan agreement. So it's difficult for me to say, but we're happy to follow up on that one.
Excellent, thank you.
And to Molly's
and then
point,
finally, oh, go ahead.
Sorry, Christine, yeah, can you add? Go ahead.
Just to Molly's point, it may vary. So as Molly said, we currently have, it's only one borrower. So for example, you'd have an entity that's the business entity, that's the borrower. There might be different people who are owners of that business. The way it's currently structured, you would anticipate that it would be that business that were actually the borrower. So if an owner left, that doesn't necessarily mean that the borrower itself would change directly. But as Molly had also mentioned, we do have situations where you have multiple guarantors. So you could see sometimes a situation where you'd have the business that's actually the borrower, and then you have multiple guarantors who are the owners. And that would be a process that we would expect if one of the business partners and the guarantors left and were looking to be relieved of its obligations, we would expect them to work with the lending bank to talk about the substitution of the guarantor in that particular case. But as Molly said, it can be kind of facts and circumstances specific, but it's good because the direct lending relationship is with the bank to actually go back to the bank and talk with the bank about their processes.
Excellent. Thank you so much for that, Christine. So another question that we've had come in here, just to be clear, if you receive a Main Street Lending Program loan, you are prohibited from paying any other loans aside from regular minimum monthly payments already scheduled. And this includes paying down any balances on existing lines of credit, question mark.
So you can, that's a great question. You can pay any payments that are mandatory and due. So anything that was pre-scheduled, this will not interfere with your normal interest or principal payments on their normal schedule. But it is correct that while during the time when you have a Main Street loan, you cannot accelerate the repayment and prepay those and kind of, again, just doing things ahead of schedule is what's prohibited, but it's certainly not intended to get in the middle of the normal flow of business. So normal payments that you've already scheduled to make would not be an issue.
Excellent. Thank you so much. So another question we have here. The max loan for, well, actually, I think it's two questions. Well, let's start with the first. The max loan for nonprofits, according to what you said, is 2019 average quarterly revenue. If the annual 2019 revenue is 1 million, does it mean the average quarterly revenue is 250,000? Does it mean that that's the size of the loan? If so, does it mean the nonprofit can only borrow 250,000?
So I think I got the math right, but then it sounds like 250,000 would be, and again, I would encourage you not to take those specific fact patterns of what I'm saying, but just to try to answer the question generally. In this hypothetical case, it does sound like 250,000 is the 2019 quarterly revenue. And so yes, that would be the maximum loan size in the nonprofit facility. It's roughly structured to be about 3 months of revenue, and it looks back to 2019. Correct.
Thank you, Molly. And then the follow-up question to that is, please restate this again. Nonprofits with less than 10 full-time employees are not eligible. Would there be any consideration for amending this to less than 10 full-time employees? What about 1099 contractors who had been with the organization for more than 5 years or who have been longtime staff members of the nonprofit without a W-2, but they're paid the same rate year after year?
So again, I would encourage you to look at the FAQs for the specific examples of how to aggregate the employees, but it's not just full-time employees. Part-time and seasonal employees would count towards that 10. Volunteers would not count. So that's very important in the context of a nonprofit organization. But you know, it's not just full-time employees. So don't know the specific facts of your questioner, but just would encourage them to take a look at that definition because it may be broader than they're anticipating. Christine, anything you want to add to that?
No, I think that's right, Molly. I wouldn't add anything. It is independent contractors are generally excluded from the definition of employee, but it will depend, to Molly's point, kind of on the specific facts and circumstances of the relationship between the kind of the potential borrower and the individuals.
Thank you. So somebody else is saying, I saw on one of the slides that you can apply even if you have an SBA PPP loan or an SBA EIDL advance. If you do have it without the advance, can you still apply for the Main Street Lending Program?
If you, sorry, was the question if you don't have a PPP loan, or
so
can you just restate it?
Yes, so it's saying if you do have the EIDL without the advance, can you still apply?
I see. It's EIDL loans come in different flavors, and I think that this is a question around that. I'm not a specialist in EIDL loans, so I would put that out just to make sure that the questioner understands that. But the EIDL program in general, there's not a prohibition on having an EIDL loan and participating in the Main Street programs. So it sounds like there's different aspects of that program, but you can participate in the EIDL program as well as Main Street.
Great, and we actually received a similar question. Would somebody be able to apply for Main Street, or would they be eligible for the Main Street lending program if they have an SBA 7A?
Yes, so we do not have a prohibition on 7A existing loans. Yep.
Great. Another question is the Main Street loan funded in full or accessed similarly to a line of credit?
Molly, I'll give you a breather. This is Jim.
Thank you.
The current term sheets indicate that all Main Street loans are 5-year term loans. While they're prepayable at any time, they are 5-year term loans, so there is no revolving aspect.
Excellent, thank you. One more question here. The FAQ mentioned employee retention in a good faith effort. Can you expand on that?
Sure, I can take that one. Yes, you know, the term sheets do talk about employee retention, and that the borrower should make commercially reasonable efforts to maintain payroll. It's a really important aspect of our program that borrowers, the purpose of the program is to maintain operational capacity and payroll through this pandemic, but we don't have, you know, we expect that to occur in good faith. We don't have specific restrictions around that aspect of the program because we want, we understand that in the small and medium-sized enterprise population, there are a really huge range of different facts and circumstances. And, you know, our goal is to have these businesses to help them through credit support be operational once the pandemic period is over, and then, you know, begin to hire. Obviously, though, employees are a really, really important aspect of all of these businesses. So it's certainly, that is the spirit, and the term sheets do require that good faith efforts be made to retain employees. But it's not a strict requirement in the sense that we wanted to make accommodation for a range of factors to allow businesses to continue to operate. I don't know if any of my colleagues want to add to that.
I think you covered it, Molly.
Molly, you are full of full answers here, so that's great. Now, I want to make sure that I got this question correctly, so bear with me, folks. We have been in business for 13 years and had a very hard time for the last year or so due to unexpected moving operation experiences. COVID hit when we were just turning around. We are doing great coming back on track. However, it might take longer than anticipated. My question is how heavy our bad history from previous year or so will prevent us from getting the MSL? So I think they're saying, would their bad history prevent them from getting the loan?
So we do look to 2019 EBITDA to assess the leverage test. So if the 2019 EBITDA was impacted, that certainly might be a factor in terms of meeting the basic eligibility requirements. That said, I would note that the EBITDA requirement is an adjusted figure. So the lender provides a methodology for making adjustments to that EBITDA for, you know, as many of you are aware, to take into account certain one-time type of factors that may not give a general sense of the repayment capacity, for example, of the borrower. So those types of EBITDA adjustments are allowed within the program. It is the adjusted number. I don't know with regard to the specific company how that may or may not impact that, and the lender is required to use a similar methodology that they've used either for that borrower or for similarly situated borrowers. So it's not a completely open-ended expectation, but I would note that as a possibility depending on the facts and circumstances.
Okay, yeah, excellent. And as Jim had pointed out, there are certain program parameters that are set by us in terms of establishing the program. The lenders will however do their own underwriting. And so again, it's one of those things where there may be components or maybe things that are in this particular borrower's history that they would want to talk to their lender about.
Understood. So I think in this case, it's subjective. You should probably contact your borrower directly to figure that piece out. Great. Final question that I'm seeing here, folks, if you have more questions, make sure you pop those into the chat or Q&A right now. Otherwise, one of the last questions I've got here are the loan documents available for review somewhere to see if they have any other questions before they apply?
So we have, so on the Boston Fed website, there's a special page that's dedicated to the Main Street Lending Program. I'm not sure, we can probably figure out if it's a reference material, how to distribute that just so people have easy access to it. But what's included on that are a variety of different things. So there are some of the program documents that are form documents, basically, that we're asking people to complete. There's a form document in particular, that's the borrower certification. So for the borrowers, that's something that they have to sign. There are not any adjustments that are permitted to that document itself. There are a series of other documents, or another one that they would sign, which is an assignment form. But the underlying loan document itself will be the lender's document. There are certain terms that are required to be included in that. And so if people were particularly interested in the details of what has to be included by the lender in the lender's own loan documentation, it's Appendix B and Appendix C, or Appendix A and Appendix B to the FAQs provide more detailed information on the expected loan, the kind of required terms to be included in the lender's loan agreement. And so if people are really interested, they can take a look at that. That information is all available on the Boston Fed website on the Main Street Lending Program page.
Thank you, Christine. So to confirm, that's Appendices A and B as in boy?
Yes, that's right. So Appendix A is the loan documentation checklist. They're specific, those are the specific provisions that we've asked the lenders to include in their documentation. And then Appendix B is required covenants to be included in the lender's documentation. Excellent. But it is the lender's own form for the loan agreement itself.
Excellent. Great. Well, that looks like the questions that our attendees have for you all today. And I just want to say thank you so much. Molly, Jim, Christine, Samira, Judy, Lucy, everybody at the Boston Fed and the Federal Reserve Board for your support of today's program. Thank you for taking this time to share your expertise with our audience. We really appreciate you walking through this so thoroughly. Folks, we will be sharing the deck from today's program as well as the recording. We'll also include this FAQ that Christine has shared in our wrap out email to make sure that you have access to all of the materials discussed today. Again, a big thank you to our partners at the Federal Reserve Bank, as well as all of our partners in the National Business Inclusion Consortium, NGLCC, Disability In, Novoba, NMSDC, USBC, USHCC, USPAC, WeBank, WeConnect International, and WIP. Thank you all so much and have a great afternoon.
Thank you.
Thank you.
Thank you for hosting us.
Of course.
Thank you so much.